So hey, we're invested in the stock market. We should expect at least a 15, 20, 25% return every year, right? Let's talk about what we should expect in the next Wealth and Whiskey video. So welcome to Wealth and Whiskey. I'm Roger Kiger. I've been a financial planner for about 30 years, helping people build their wealth and protect their legacies. So the Wealth and Whiskey channel is pretty aged and unfiltered, right? We talk about things that a lot of advisors don't want to talk about, and sometimes a lot of investors don't want to hear about. That's why it's unfiltered. But we need to talk about all these things so you can see everything kind of exposed and upfront and honest, okay? And the thing I wanted to talk about today really is what should we expect out of the stock market? The reason I'm doing that today, it's a little bit of a timing issue because we're getting a lot of clients that are nervous about where the market is. So really it's a function of expectations, right? What do they expect? What do you expect out of your investments in the market? An investment in the market can be, buying one or two stocks through Robinhood, your 401k, IRAs, or if you're closer to retirement and you're managing a larger portfolio, there's some risk and volatility and other issues with it. So briefly, I just wanted to talk about return expectations because there's a lot of other things we can talk about regarding expectations, but let's talk about the returns because right now that's really important. So how much should you expect? And how much should you expect this year? Should you get in the market, get out of the market because maybe it doesn't look as good as it has in the past? So I would argue that right now the expectations for returns are elevated because we had some pretty good years, right? So we had a little blip in 2022, maybe a little blip in 2018, but by and large, all the other years we've seen 10, 12, 15, maybe 20% returns. And if you were invested in some of the AI stocks, the really aggressive stuff, like the NVIDIAs, Palantirs, some of this, the technology and AI momentum that's pulled the market along for the last few years, you've seen even higher returns. Great. We like that. We shouldn't expect it, but we love it when it happens. The problem is we get to the point where we expect that that's normal. We should get that every year, right? That's not how this works. That's just not how the stock market works. So regarding the returns, let's talk about some historical averages from a volatility perspective, right? So historically, the market can see a 10% drop historically almost every year, and that's normal. What I hear from my people is, hey, the market's down 10%. This is terrible. That's just part of the volatility. If you see it go up 15% a year, you should also expect it to come down 15% a year. But by and large, we don't like seeing those numbers, right? We don't want to see the drops. And I would also argue that the drops are not as bad as they are perceived because most investors tend to look at the value of their account or the value of their loss based on what their all-time high is. Well, I've lost money. My all-time high was X, and I'm down 15% from that. Well, but if you're up 30% to start with from what you put into it, maybe that's not the right way to look at it. Maybe you should value your loss or gain from what you started with and how much it's appreciated. Because if you think about every stock, it's going to hit some all-time high, but theoretically it may not stay there. It shouldn't stay there. In the short term, it will fluctuate from its all-time highs. It shouldn't go back to its all-time lows, but because it's hit some high watermark isn't necessarily the place or the benchmark to use when you're gauging your loss. It doesn't mean it's a loss if it's below its all-time highs, right? So I think there's some of those things that help us look at our account values and say, I've lost too much money. Well, have you really? Maybe not. So measure those gains from some of the all-time lows, not how much you've lost from the all-time highs. Think about what you put into it and what you've made along the way, right? So back to the historical numbers, the 10% drop in the S&P 500 every year is historically the average. A 20% drop in the S&P is not uncommon, at least once every 5 years. But we haven't seen that really since COVID or some of the financial crisis. And those were 20, 30, 40% drops, but it all came back as long as we stayed invested. That's why the stock market is a long-term investment. You have to stay invested through those volatile years. Now, are there opportunities when it's down that much to put more money in? Absolutely. The worst thing to do is take any money out, but those are opportunities to buy in at that point. So, really just wanted to talk through some of those volatility things and make sure people understand that the return they saw in NVIDIA last year isn't the return you should expect in the stock market every year. Because the patience is absolutely rewarded, especially based on what stage in life you're in. Are you contributing, building wealth, growing wealth, or trying to protect it? They're all really, really important stages that you have to manage differently. And that's where the patience, the work, and the consistency comes in and does pay off for you, right? So remember to work through all those stages. And if you need help starting that journey, download the Legacy Blueprint in the link below. And don't hesitate to ask us any questions that you have. Please like and share our videos. We'd like to make sure that you don't miss any of the future ones, so subscribe as well. I'm Roger Kiger. I very much appreciate your time, and I look forward to seeing you on the next Wealth and Whiskey video. Cheers.